Today, failure to launch with Tarric Brooker. Hello again, it's Martin North from Digital Finance Analytics, well, that is post covering finance and property news with a distinctively Australian flavour. And I've got Tarric Brooker, journalist, with me today. Hi, Tarric.
G'day, Martin. How are you? It's been a while.
Yeah, it has been a while. A few things going on, eh? Never a quiet moment.
No, never a dull moment. There's always something going on in the world, especially, with COVID, with, Biden's infrastructure package, with all these different things. There's just so much to talk about.
Yeah, there is. And interestingly, of course, the infrastructure package turned out to be a little smaller than perhaps was originally envisaged.
That's a bit of an understatement, isn't it? I mean, just a few days ago, Yellen was talking up the possibility of $6 trillion in infrastructure. And then there's the headlines today of over $1 trillion in infrastructure agreed to. But once you actually drill down into the nitty gritty of the thing, you actually realize that there's only $559 billion in new spending. Now, don't get me wrong, a couple of years ago, $559 billion in infrastructure spending would have been a huge win for for the Democrats, for the American people. But well, if it all goes to the right place, that is. But in the world of $2.8 trillion worth of stimulus over the last 6 months, it's just a little bit small.
Yeah, exactly. And if you look at it carefully, there are a number of what I call slush fund projects as part of it, right? So, it's not all clean infrastructure spend, is it?
No, Martin, come now. Slush fund projects, what are we talking about here? American politicians using various projects to further their ideological and political needs? No way.
Oh, sorry. Maybe I must have taken my over-cynical tablet today. It's Friday, so I'm allowed to.
Well, the thing is, there's always going to be the pet projects. If you drill down into the original CARES Act or the various stimulus that we've got in December and then again from Biden, it's once you drill down into it, there's quite a lot of that sort of thing. There's quite a lot of those, pet project. I mean, it's like those rider bills that you get in America where you got, there's, okay, we're going to have clean water for Flint, Michigan, but we're going to add in all this other stuff that fulfills all of these other things in our ideological agenda that we're going to put on top of it.
Yeah, exactly right. And I guess you could say that the same thing sometimes happens in Australia too, where, if you actually strip away what was really spent compared with what they said they were going to spend on it, it can be quite different sometimes. It seems to be part of the way that politics goes. It's the announcement rather than the detail.
Well, it's a bit disappointing considering the current circumstances now. We're facing potentially a winter with COVID, in Sydney and in Melbourne and, potentially in Queensland as well. And I mean, obviously, while we hope that somehow these outbreaks are addressed as swiftly and as efficiently as they have been in the recent past, a winter without JobKeeper, without stimulus being targeted at the right things is going to be, well, it could be quite challenging. And, I think that a lot of Australians might end up finding themselves being quite annoyed with the Prime Minister for saying that, well, I'd rather our corporations be profitable than not profitable when in terms of clawing back that JobKeeper money, which may be, just terribly needed by small businesses if things keep going the way they're going.
Well, as you know, I run 3 scenarios in my models, and the most positive is the virus gets under control and the borders reopen, but the least positive is it gets bad for quite a long period of time, and it has a really big economic impact. But the real issue is that money that was released the first time around went to the wrong places, and this time around, if we go the same route again, it's going to be pretty frightful for many people.
It is. I mean, some analysis from the Australia Institute showed that somewhere as much as 70 to 80% of the funds from JobKeeper were used protecting jobs that were never actually under threat in the first place. Now, I don't know how accurate that assessment is. It's obviously an incredibly difficult thing to quantify without, just incredibly wide-ranging data and going down to an absolutely granular level at different levels of industry and places, obviously depending on their very, very different experiences with the virus. But, I mean, let's say even half that, 35 to 40% of, what is it up to, about $100 billion is a lot of money that we could now be spending on, helping people in the here and now. But I mean, at the end of the day, it is what it is, and we got to throw it all into the economy, because how else are we going to protect the property market?
Is the property market to be protected? I didn't realise it was an endangered species.
Oh, it is, Martin. I mean, we've got some of the most overvalued property on the face of the earth. I mean, it's got to be an endangered species at this point, the way it's getting protected. Wherever you look, state level, federal level, it's all about the property market. It's the only game in town.
Well, that's, of course, why we have some of the most wealthy Australians compared with other people around the world, right? I mean, it's very interesting, that latest ABS data that came out just a couple of days ago. It said, actually, we are really, really wealthy as a country. But actually, if you look carefully, actually, the reason we're wealthy is because it's all property prices related, and it's mostly debt-driven. So it's not real.
Yeah, well, sometimes I sort of feel like we're the nation-state equivalent of the Dogecoin bubble. Where we all look at our Coinbase account and we just go, wow, look at all the money we have on paper. But the question is, how long is that going to persist in sort of real world conditions without the various factors that we have supporting it? And I think it's also just important to keep in mind that there is a lot of scope for this to continue. There's, as we've discussed previously, as you've shown me in your data, that that the government has a lot of scope to potentially throw even more money at this, to do first homeowners grants, to do all sorts of wacky crap. Because, I mean, you and I were hoping that the government would have some semblance of fiscal responsibility when this started. I remember talking about it with you.
We can hope.
well, hope. Hope is the operative word there. And unfortunately, that's not what's happened. It's just been, oh, well, we blew $40 billion, whoop-de-doo. And it just sort of makes you think, well, for another couple of billion for home builder, what's to stop them from doing it again and again and again and again?
Yep.
So, you just got to ask yourself, where does it all end?
Well, it doesn't have to end, because basically, ideologically speaking, they can go on doing that for a lot longer, right? And, some people have said to me, well, you were suggesting that prices could be sliding. And of course, they're going up. And to which I replied, well, did you expect that much money to come through, right, and continue to come through? And look what the Fed did. I mean, I don't think there's anybody who, prior to the COVID incident, would have predicted that amount of debt. And of course, even a year plus ago, Frydenberg was talking about getting the budget back into surplus and all those sorts of good things, and not having any debt. Well, that game changed very quickly. And the bottom line is this. They have the capacity to go on doing this for a lot longer, right? They can put a lot more money into the system. But there is an interesting observation. I don't know whether you've noticed it. In the US, with the Fed still buying its $120 billion a month and all the other stuff there, in fact, the total flow of stimulus is reducing, not increasing. Despite all that stuff still going in, it's actually coming down, right? First point. Second point is, if you look carefully, there's a thing called reverse repos, right? And reverse repos is where the banks send their money back to the Federal Reserve and basically get interest on it because they don't know what to do with it, right? That's a really big issue at the moment. The reverse repos are really big, and that suggests to me that maybe there's so much money sloshing around the system now that it's not going anywhere, it's not doing anything.
Well, that sort of raises a rather interesting point with the markets more broadly, because it makes you, like, say, for example, the reverse repo thing at the moment is sucking about $800 billion overnight out of the $800 billion US dollars, I should clarify, about $800 billion out of global financial markets overnight, mostly through US banks and other counterparties. But it does make you think, in the sense that that's $800 billion worth of QE that's effectively being cancelled out, because those bank reserves that the Fed has effectively printed are then just being parked back at the Fed. So, people say, oh, but, the reason why stocks are rising is because of the expansion of central bank balance sheets, the expansion of liquidity, et cetera, et cetera. But then the question then becomes, okay, but at the moment, the amount of liquidity being sucked out of the global financial system is greater than the amount being injected. So if it was solely about liquidity and not about psychology, then technically shouldn't markets have been falling significantly if
Well,
it's solely about that?
absolutely. Well, they should have been. And I did a show earlier this week highlighting the reduction in the money supply in the US. It's gone down a lot, right? And the net stimulus is also falling, right? And yet most people are still saying, oh, they're just throwing more and more stuff into it. So they're not looking at this in the round, right? We're actually in the situation where, despite the Fed still doing what it's doing, the net position is going backwards.
And that's always what was going to happen. That was always going to happen. Like, I mean, there is some analysis I saw back in March last year when all this stuff was first being considered. Everyone was talking up this huge level of stimulus. But once that's withdrawn over time, once people have spent the money, once the pent-up demand has been exhausted, they've blown through their savings, whatever it is that they choose, people choose to do, and all that money is gone, then you end up with this weird hollowed out economy whereby there's just, where does the demand come from? It's sort of like, I mean, it's a bit like the lumber market, really. You've got all this demand, and then all of a sudden you get to a certain level and it just goes, the demand just starts to fall away. And that's what we're going to start to see around the world, because we've had all of this artificial demand created by this stimulus, this stimulus that's never before seen, in terms of its scope, in terms of its duration, in terms of its overall size and impact on the economy. And the data shows, even the Treasuries, the Australian Treasuries data, I might add, shows that once that stimulus is withdrawn, GDP growth goes backwards.
Yep.
Now, whether or not the economy goes backwards or not is another matter, but GDP growth goes backwards. And that's what was expected after the Rudd stimulus I think it was forecast for 2010, 2011. But that didn't end up happening because of the mining boom. But this time we don't have another mining construction boom to replace the one that we had previously. So that reckoning hasn't been avoided. It's just been postponed.
Oh, well, it's easy. Just build some more houses. That'll do it.
Well, that's the thing. It won't do it though, will it? Because relatively speaking, home builder and all this home building is only a fraction of what we need to replace all the money that's coming in. And to be completely honest with you, like, Australia at this point isn't really my chief concern over the next quarter, maybe two, because as we've discussed, we've got an election coming up. There's going to be plenty of money getting thrown around as Morrison tries to resecure power. Not only that, but now he's got to placate Barnaby Joyce and a resurgent National Party, which is going to cost him even more money getting thrown into the economy in the bush. So Australia's not really my chief concern, but my growing concern is about the US and Europe, both in terms of concerns with the virus and what happens there, because we don't know what's going to happen once you see large-scale spreads of the Delta strain in vaccinated populaces. Hopefully, it goes relatively well, but it's an unknown until we see further proof. But by the same token, you look at things economically, and they don't really look that great. Things are starting to roll over. You start seeing things starting to peak. And that's not what you want to see, not after you spent all this money.
No, absolutely. Well, of course, more and more of the analysts are now buying the Fed story of transitory inflation, right? In fact, there was a very good couple of Fed articles that came out this week that went into some detail looking at where the inflation was and what had caused it. And basically their conclusion, again, was it's transitory. A lot of it's related to COVID. A lot of it's related to just small sectors of the economy. But the underlying outlook for inflation is still relatively benign, right? And even in the UK, where they've come out with a relatively strong inflation number, it's still the same. They're still saying it's distorted, right? So let's just pause and think about that. All that liquidity stimulus, all that money that's been thrown into the system is failing to launch anything like significant growth into the medium term. Yeah. That's where we are.
Yeah, absolutely. That is the long and short of it. I mean, that's what really just gets me about the entirety of the media narrative, the financial market narrative, in all of this, to be completely honest with you. Because I've been going on about this for a while now. I'm months and months and months and months. I've been saying that data is going to disappoint. Inflation's going to come in hotter than expected. Now, I'm a journo who does this in my spare time. and I've been more right than the vast majority of analysts, and that hurts my brain, frankly. It shouldn't be like this. Someone who dedicates their spare time to this shouldn't be getting it better, getting it more right than someone who's earning seven figures.
Well, but let me put this point to you. A lot of the analysts are contexted within the financial organizations or other, political organizations. So they actually have vested interests in steering the narrative a particular way. Now, I've had the view for some time that quite often the analysts are actually influenced by the need to propagate a particular agenda. And I think at the moment we are seeing that in spades.
Yeah, well, I mean, I won't comment on individuals and stuff like that, but it certainly does feel like that sometimes when you see these absolutely enormous misses in consensus estimates. I mean, like, I'm not sure you saw the other day, but the US services PMI, it came in an absolute mile from any of the estimates of the major analysts, and it wasn't even near the bell curve. The bell curve was on, like, the other side of the freaking world.
Yes.
Now, I know that 64 and 70 aren't, enormously, hugely different in terms of, because it is a diffusion index, it's also incredibly subjective. But by the same token, if you're going to be seeing stellar results, the time is now. But they're not happening. You're looking at things like, or people say, oh, but what about oil? Oil prices are rising. It's like, yes, because OPEC is deliberately limiting production. Overall oil production and consumption are still significantly below where they were. It's because we allow this cartel, this literal price-fixing cartel to exist.
Absolutely. And talk of price fixing, you could argue gold the same, right? Because there were many people talking about gold going to 3,000 to 5,000 US, right? It's sitting below 1,800 at the moment, and probably won't move very far from that. And then, of course, we have our crypto communities who, of course, were quite recently celebrating Bitcoin at 68,000, and it's somewhat lower than that at the moment.
That's the thing, though, isn't it? It's the fact that just, markets are all over the show at the moment. You see these big swings, you see these big moments of volatility. And I mean, the truth is that it's just an incredibly, incredibly distorted market. The Fed has broken things in just a way that has never been seen before. And I mean, just like we discussed about the reverse repo situation, it's literally a case of psychology over liquidity. So, if you put all these different things together, you've got data peaking far too early. You've got stimulus coming in at less than a tenth of what Yellen was talking about. I mean, none of this bodes terribly well for growth or for, underlying corporate earnings in the long run.
Or indeed, for the benefits of households and communities in the various countries that those central banks are meant to be serving. I mean, I've said all along, of course, central banks are ultimately there to protect the financial system and financial stability. They know it's not really real people, but they do have consequences for real people. And in my surveys, I'm seeing it in spades in terms of high mortgage stress and in terms of small businesses really struggling. And there's a complete disconnect still between the real world and the real economy and the pseudo world that these mandarins and gurus live in, and the predictions they make and the assumptions that they describe in terms of how things are just so far off the truth.
They are. And I mean, let's just explore that for a moment. The whole central bank protection of the financial system, of the status quo, etc. Now, let's say imagine that, by some crazy sequence of events, I'm the chairman of the Federal Reserve. If I were in that position, there is no freaking way this bubble would have happened on my watch. Even if it was about protecting the 1%, even if it was about protecting the financial system and the status quo, because you've got to massage it. You've got to be a lot more targeted. None of this blanket bullshit. You've got to be careful with what you do, because if you're not careful, all you're going to do is create the seeds of the next crisis. Now, Powell, if you want to, bail out your moron mates who've invested in junk bonds up to their freaking eyeballs. Okay, fine. You say, we're going to buy some junk bonds. We're going to do this. We're going to do that. But this is as part of normal market functioning. And if you guys get yourself into trouble after all this ends, after COVID's finished, after the major impact on the market's gone, you're on your own. That's it. None of this, we're going to make you all whole crap. None of this, we're going to massage the markets. We're not going to raise rates. We're not even going to talk about tapering and all this other crap. Screw that. This is about, if you want to protect the financial system in terms of protecting the existing wealth of existing stakeholders, and I realize that that's really what they're doing, and you want to sort of at least have some semblance of long-term stability, you got to be careful. The S&P 500 should realistically be around about sort of a decent-ish recovery, maybe like 3,000, 3,100, something like that, not the 4,200 plus that we're seeing, because that way you've got an even bigger bubble to burst in an even bigger way and do even more damage to the holdings of your buddies in the 1%, which is ultimately counterintuitive.
Right. And what you've actually said is you should let the market be the market, rather than the market be completely manipulated and stuffed full of cash to try and actually, protect the financial system and the financial flows. In other words, stop any of the banks falling over, and despite the fact they've made bad bets and they've taken on risks, those risks are being basically covered by the good old central bank.
Pretty much. I mean, I realize that there is a certain amount of manipulation and protection of vested interest that goes on, and I mean, even what I'm talking about now, that still protects the vested interest, and it's sort of the ideal devil's advocate sort of position. But what they're doing now is just incalculably stupid, because they're setting the world and markets on an unsustainable course, because no parabolic move ever resolves itself in a nice, quiet, comfortable way.
No, and I guess the question then is, there are people who believe that there is more than just, a happy accident of thinking across central banks and a happy coincidence of strategies. Is it something more than that? My own view is I don't think it is. I think they actually genuinely think that what they're doing is right, but it's through a very myopic lens, and it's a very narrow lens. And unfortunately, I think all of the evidence, if you stood back and looked at it, would suggest that it's failing.
Yeah, I would definitely agree. I mean, at the end of the day, you've got Powell and Kashkari and Bullard and all these members of the Fed getting up there and talking about inequality, and I just want to freaking slap them. You had Bostic the other day coming out and saying that there isn't a US housing bubble, even though prices are up like 24% in the last 12 months and people are being priced out left, right, and center. Bugger off.
Exactly right. And of course, the most recent data from the US housing sales was also not what they expected. Another example of a miss, right?
I'm so surprised. Who would have thought that pricing millions and millions of people out of the housing market would cause things to reverse so rapidly? And just while we're on the topic of the US housing market, people have been saying, oh, but it's low supply causing this. It's low supply. It's low supply. Now, let's just put that to bed once and for all, right here, right now. As of this moment, the sales to stock ratio in the US for their housing market is practically the same as it's been in every other May for the last 5 years.
Yep.
The level of stock on the market has risen significantly, and that is no longer a defining factor of why US housing prices are rising. It has nothing to do with it anymore. And not only that, but that was for the data for May. So I imagine that the level of stock on the market has only continued to rise significantly. So, it's about low interest rates, and not only that, but it's about rich people buying houses. If you look at the turnover rate of houses by their valuation metrics, by their demographic breakdown of valuations, I should say, it's all the activity is in the upper echelons. All of the growth is in the upper echelons. It's not in regular everyday Americans who've taken advantage of low interest rates. Most of them, they don't have the security to do that.
Yeah, exactly. Well, it's interesting. There was an article in the AFR the other day celebrating the top end of the luxury apartment market in Sydney. I don't know whether you read it, right? Talking about the 15 million and 20 million properties that were sold in, the old Cirrus development, the redevelopment there, right? Now, I have to say that is not the housing market. That's a very, very small segment of a subsegment of a subsegment, right? The top end of the market is driving a lot of weird behavior, and there is a lot of money there, but it's such a small proportion relative to the real market and everybody else. But again, it gets way too much focus.
Well, don't let a little thing like the truth get in the way of the good story, mate.
Oh, sorry, I forgot that.
No,
Yeah,
it's not. I mean, look, is the housing market strong? Unfortunately, absolutely, it is. It's enjoying pandemic-driven demand. It's enjoying low interest rates, and I mean, even though you're probably getting thousands and thousands of people priced out every day, considering how rapidly prices are rising, but it's just unfortunately it is what it is, and while you hope that it's going to reverse at some point in the not too distant future, you just don't know what sort of crazy crap Morrison and Co. and Lowe and the rest of them are going to come up with, especially with an election on the horizon.
no, well, that's certainly true. It's interesting that Norway actually announced, for their central bank announced they're going to start putting interest rates up in September.
Well, that's interesting, and that leads me in actually to the first chart in my little slideshow
Oh, great segue.
Yeah, yeah, yeah. My mum always said I was good at those, and then she said that with a great deal of sarcasm, I might add. This is a chart from JP Morgan on the interest rate futures for the overnight rates of various different countries. Now, if you'll see Australia, which is about sort of in the middle there, we're now pricing in 1.5% worth of rate hikes over the next 4 years. Now, that would, considering that the current market is basically thriving on 2, 3, 4 year fixed loans at 1.7, 1.8, 1.9%, that really does indicate that we've got, I don't know, shall we say, a bit of a problem in the long term, because eventually these cheap rates are going to come to an end because they're funded by the RBA's term funding facility, which has been providing $200 billion in bank funding at just 0.1% to the banks. And then also it's been supported by low 3-year government bond yields, which I'll get to in a moment. But basically, if you take the RBA's data on the standard variable rate that people are currently paying in Australia, that would then, and you whack a 1.5 percentage point rise on top of that, that would then take the average variable mortgage in Australia up to about 4.6%. Now, while that doesn't sound too bad for anyone who got a mortgage anything longer than 4 or 5 years ago, if you're someone who's bought relatively recently, you've got yourself a fixed loan on a cheap rate, it could be quite a shock going from 1.8, 1.9% up to 4.6 like that.
Well, let me throw in a comment there because, of course, I model sensitivity, right, of interest rate rises, and it's interesting to see there's 41% of households in mortgage stress at the moment, right? If rates went up the way you're suggesting, that would put people close to 50% of households would actually end up in a degree of mortgage stress. It's that sensitive, and that is a very, very concerning number.
Yes, it certainly is. Well, I'll move on. I mean, and not only that, but one thing I should also emphasize is this is how the market is currently pricing rates. It doesn't imply that there's a ceiling that's as high as rates will go. They could indeed go higher. They could also be a lot lower. It just depends on how things turn out in terms of inflation. Now, this is the 3-year bond rate for the Australian government. And this is one of the benchmarks that the banks use in order to do their long-term funding, in order to fund long-term fixed-rate loans. Now, a few weeks ago, it was just 0.07%. So, and today it's 0.463. So if you're talking about that then being passed on to the banks, and not only that, but it's not only the fact that this rate will be passed on to the banks versus the cheapy 0.1% that they've enjoyed from the RBA's term funding facility. It's also the fact that they also then need to pay a spread on top of that to an investor in order to then, write the bond that will underpin these new 3-year, 2-year, 3-year loans, which is something that's important to keep in mind because we could see fixed rates rise a lot higher than what variable rates will do. Sorry, rise a lot higher, relatively speaking, to where they are now.
Yeah, just a quick observation on that particular chart because I actually raised it earlier in the week, and the reason that it jumped up was because the Reserve Bank was targeting the earlier 3-year. That is now I think it's the November rather than the one that they're targeting, which is earlier on, right? So they're still targeting their 3-year to 0.1. But the longer term, as you say, beyond there is definitely signalling a rather different story when it comes to what's happening with future rates. And I keep saying to people, you've got to assume rates are going to go up. So anybody who's thinking of buying a property and getting a mortgage, don't just work it on the current interest rate, but you should add in 2 or 3% on top and make sure you can still cover it, because that will be prudent and very sensible. Despite what the banks may say you can borrow, check that you can really borrow it.
Yeah, I think it's always good advice to just really explore all of your options, to talk to the right people, to talk to, a good mortgage broker, to talk to a good financial advisor, and really just get into the nitty gritty of your different options of, is fixing a loan a good idea for me? How long should I fix it for? What's the most beneficial thing? And I think that that's all really important right now, with the backdrop of all these different distortionary things impacting fixed rates, because, we could very well see, some sort of a shock in a couple of years' time as these cheapy rates do, come to an end, or who knows? I mean, we could have a negative cash rate 3 years from now, for all we know.
Well, who knows? But the point about fixing, and, without giving financial advice, it gives you certainty, right? So if you can fix for 2 years, 3 years, or 4 years, right, then at least that there's not going to be an upside surprise. But most people are still on a variable rate mortgage, which basically means that if rates do start to move, guess what? The banks will put rates up. And that doesn't mean, just to be clear, that doesn't mean that the Reserve Bank moves the cash rate, because a lot of those moves will be out of cycle moves as the money market rates that the banks access change.
Yeah, exactly. Absolutely. Well, I don't really have anything to add to that. That summed it up pretty well.
Cool.
Okay. This is an interesting chart from Alex Joyner at IFM that shows that, despite all the hype about the Aussie economy and how we're, bulletproof and all this and all that, the reality is if you actually look at private and non-mining business investment, we've never recovered from the global financial crisis. It's still a fraction of what it was then. And despite all the song and dance about the rate cuts, about, the government's asset write-offs and various tax credit programs that are designed to benefit businesses, the investment just isn't there. And anyone who's done an economics class will tell you that without businesses investing, you don't really get growth. And if you actually chart this inversely with disposable household income, it's actually very, very similar. Sorry, real household disposable income per capita. I should really be very, very clear.
Right, and that basically says that our economy is not firing at all well. Okay, we've got all the government money flowing around the system at the moment, but private investment and, that's the stuff that will create momentum and growth for the future. Well, it's crickets at the minute.
Yeah, exactly. And I think it's also important to remember that also includes that businesses were drawing down on their credit lines to protect themselves, and it's a pretty ugly set of numbers.
Yep.
And this is what I was talking about previously in terms of the level of activity in the US housing market based on price range. Now, if you're just a sort of everyday average American buying a house, your family earns around about $50,000 a year. You buy a house that's 3 to 5 times income, so sort of $150,000 to $250,000. The number of Americans buying homes in those price brackets is actually declining, despite the massive falls in interest rates. But if you look at the chart, at the higher you go in terms of the price bracket, the more activity there is. So, the argument from central bankers, from the supporters of their policies, that we're seeing this, renaissance in borrowing, that people are benefiting from low rates, when in actual fact, the people who are overwhelmingly benefiting from low rates are these rich people buying bigger houses, second homes, holiday homes, all at, record low rates fixed for 30 years, which, admittedly, I guess if I was loaded, it'd be a pretty sweet deal.
Well, it's worth, if you were to put the distribution curve of overall households across that, right, most of them would be over on the left-hand side rather than on the right-hand side. And if you then actually put the wealth chart on top of it too, guess what? That would be pretty much the exact opposite, with an exponential rise towards the right-hand side, right? Because basically we know that there is a small population growth, a small proportion of the population with massive amounts of wealth.
Yeah, exactly. And that's something that's happened. I mean, as you say, if you look at the most recent charts, the share of wealth held by the bottom 99% and also the bottom 50% has fallen significantly because of the fact that the wealthier obviously overwhelmingly own the assets in, share markets, bond markets, etc.
Yep.
Speaking of stocks, this is a great chart from the Bank of America. Now, I should say before we get too excited that this figure is annualized, of the year to date annualized, because Americans like annualizing things for some reason.
They seem to need that to be able to understand it.
Yeah. But it just shows that, I mean, it was actually a very similar chart back in March, but obviously now we're in June. But it just goes to show that we really are seeing a real all-in moment into the US stock market. And even if you compare, sort of like pre-global financial crisis, there's really no comparison at all.
Yep. So we know where a lot of that money's gone then, don't we?
Oh, I wonder. And here's another one. The rise of YOLO investing. We're seeing younger generations, Gen Z, Gen Y, borrowing most of them borrowing significant amounts of money to invest. Now, this is both into stocks and crypto, but it just goes to show how younger people are just putting it all on black. So, putting it all on black would probably be safer, but they're taking big risks with borrowed money in order to. Sorry, go Martin.
Well, I was just going to say, the point about that is, of course, that banks and financial institutions love cash flow. They love people to borrow big because they know that they're going to have to repay that over a period of time. And of course, their business is all about generating cash flow, right? Unfortunately, the younger generation have known no different, right? So for them, loading up on cheap debt and then making these sorts of speculative investments is just normal course of business. But I keep saying to people, well, interest rates are really low at the moment, but as we said earlier on, it may not always be that way. And the problem with leverage investments is they can go really, really pear-shaped really quick.
Indeed, and I think that's really part of the equation in all of this. But looking at the chart, I also understand why these generations are doing these things, because they're in a situation now where they've watched, where a lot of people have watched their chances of home ownership evaporate over the last 12 months. I mean, this is arguably even more true in Australia, where deposit requirements are generally higher. You can't just 3%, 5% deposit, and that's sort of pretty standard like it is in the US. And it's like the only way they've got a shot at achieving a life like their parents. And I'm not saying this is like this for everyone. But for a lot of people, it's like, well, I'm just going to roll the dice on crypto or meme stocks or whatever, and you just come what may. But I also think that I should also clarify that I'm not saying that all investing in crypto is a YOLO thing. But if you're taking a big bank loan out and you're putting 100% of it into Dogecoin or Cumrocket or whatever it is, that's not really like putting some money into Ethereum or something like that has some utility, that has some long-term potential and some long-term clout as an investment. It's just it's not what even some of the creators of these coins are calling a Ponzi scheme.
Well, it's interesting just to come in on there, because of course a lot of those are quoted as these are really great, quote, investments, right? Well, investments have some characteristics. One is what their value is, and why their value is what their value is, and essentially what the trajectory may be into the future, right? None of that's true for the bulk of these cryptos. So to my mind, it's more a religion than it is actually an investment. And yet, of course, it's a speculative, a speculative thing. But they are being positioned and sold. That's why you get all these glossy pictures of bitcoins with gold, gold coins, right? Trying to give the impression that they are actually mirroring old world in the new world. I'm afraid that's just propaganda.
Well, the top during the Great Depression, prior to the Great Depression, before the market crash, was the Shoeshine Boys all giving stock tips, and now it's not Shoeshine Boys anymore. It's porn stars promoting crap coin or whatever it is.
Exactly right.
Okay. Now this is actually one of the big ones going forward. That now that the Chinese credit impulse has rolled over in a rather big way and has gone, and at least the 6 month one has already gone negative. China's economic data has started to surprise to the downside, and surprise to the downside significantly. Now, part of this is the fact that apparently some analysts have no freaking clue what they're doing. Because don't get me wrong, there's some great China analysts out there, people like China Beige Book, who do an absolutely fantastic job at predicting things within China, at measuring and quantifying what's actually going on in China. But as you can see, overall, people are starting to be surprised to the downside about what's going on in China. And you're even seeing that recently, like the South China Morning Post came out with an article within the last 48 hours about how the government is cutting their investment in high-speed rail. So all of these things are coming off the boil as Xi takes his foot off the gas, of the debt accelerator, and decides to be a little bit more prudent. Now, that could be a problem for Australia in the long run if they decide to pull away from the construction-led growth model. Whether or not that actually ends up happening is a multi-billion-dollar question that, frankly, I don't have the answer to. But it just goes to show that China, as the engine of marginal growth in the world, is falling away. And if America can't rise up to replace it in the same way and create the same level of growth in the same long-term fashion, the global economy, frankly, has a problem. And honestly, unless they put even more and more and more stimulus into the US economy, I don't think that there's really any potential that they can replace China in that respect.
No, I agree. And of course, China also has recently announced they're going to start releasing strategic stocks of some metals, right, to effectively try and push the the global price down as well. That's something else that I'm not sure that we've woken up to here in Australia yet.
Indeed. I mean, that's something that I'm actually covering in an article this weekend, and it is something that is definitely worth discussing. And to be completely honest with you, I think that we really need to have just a real discussion as a nation, as particularly our leaders and policymakers, about what we want for the future. Because, I mean, don't get me wrong, I'm not saying Australia's future can't be partially driven by mining. It certainly can. Rare earths and lithium and cobalt and nickel and all these things that are going to be needed to build this new world we have a lot of here in Australia. But we can't just continue to rely on the iron ore bulk carriers to China forever and ever.
Spot on.
Okay, the fake bond market. Now, this is actually a big one here in Australia. I don't actually have the fully updated numbers from the RBA. So if anyone actually has them, just tag me on Twitter and let me know exactly how much issuance the RBA has bought, because unfortunately I can't find a running total of exactly how much they've bought. And that's one thing I do like about the Fed. At least you can go on the St. Louis Federal Reserve website and all the information is there. You know exactly how much of the bond market the Fed has bought. But here in Australia, it's a bit of a different story. And this just shows that basically, in terms of the European bond market, it's got to the point now where the ECB, or the European Central Bank, is buying 98% of new bond issuance. And that means you don't really have a bond market anymore. You've got this really strange, distorted, fake market that bears no resemblance to reality. I mean, this is why that Greece can now borrow for less money than what it costs Australia to borrow. Now, I don't know about you, but I would much rather have Australian government bonds than Greek government bonds. But but by the same token, it's also equally true that the RBA is buying more bonds than the Australian government is issuing. So, in a lot of ways, our bond market is just as fake as Greece's, and in some ways, I haven't done the math to fully confirm this, but it wouldn't surprise me if our bond market was even more fake than Greece's.
Could well be, and it's interesting you make a very good point. It's very hard to get really good data on precisely what's going on. It's a bit like that shifting the bond end date, right? And it's hard to know precisely where we are, because that particular bond that the RBA is targeting is not now generally reported in any of the indices. So it's another example of obfuscation.
Yeah, exactly. All right, and that's it for today. I decided to keep it a little bit short rather than a marathon.
No, it's excellent. Well, those are really, really good slides, and congratulations on that. The power of those, I think, are absolutely there. And I might add one more, which I'm just going to pick up that slide that I mentioned earlier on about the stimulus being withdrawn in the US, because you overlay that too, and I think you get a really good picture of precisely, where we are and why it is that we're saying, well, it's failing to launch.
Yeah, absolutely. It's honestly, it's a little bit ridiculous, to be completely frank with you, because I sort of feel like we're the guy with the bell walking around with the placard on us saying the end is nigh. But the truth is that if you actually look at history, if you actually look at when this level of money has been withdrawn from the economy, say not at the end of 1945, 1946 is a perfect example. A very, very large amount of money was withdrawn from the economy because we didn't need warships anymore. We didn't need uniforms and bombs and bullets to go fight the Nazis and the Japanese anymore. And that in and of itself created a recession here in Australia, quite a serious one, I might add, as well. And you're talking about a level of government spending being withdrawn that's very, very similar to what has been withdrawn and what will be withdrawn over the coming months or coming years, I should say. But that's the reality of the situation. And the thing is that back then, you're talking about this money flowing through the economy, flowing into shipbuilders, flowing into ammunition suppliers, flowing into all these different things all over the economy. Everything from the local farmer who makes the wool that goes into the uniform to the steel manufacturer, whatever. But the difference this time is that the money has been given directly to businesses and to households, which means that the withdrawing of it is going to be even more stinging than it would be if it was flowing through the economy and actually doing something useful.
Absolutely. Well, the only way out from that will be to do a UBI, right, which is to basically put more money back into people's accounts to try and continue to allow them to spend, because there's no other mechanism, right? But that, of course, takes you down a very interesting rabbit hole, and then you can overlay digital currencies over the top, and then what you end up with is a central bank digital currency where you have an account at the central bank that they credit that you can access to spend on things. Right, and that's the end game.
I honestly don't know how all this ends, to be completely frank with you, because you've got this enormous level of central bank intervention. You've got the Fed buying $120 billion worth of bonds a month. You've got the RBA buying whatever the hell they want. I mean, obviously I don't know exactly how much it is because, as you say, the data is a bit opaque. But it's just a ridiculous level of intervention that, frankly, can never be turned off, not without some serious pain. So the question then becomes, does it ever get turned off? Are we just going to live in this pretend world forever and ever until it finally just all gets so incredibly distorted and so incredibly risky that it all just blows up in one ultimately cataclysmic explosion of just central bank idiocy and just fiscal policy makers going overboard? Because I'll be completely frank, I don't know where all this ends. I mean, I'd like to think that somehow I do, but to be frank, I don't. I don't think anyone really does.
No, well, I'm on the view they've got into this cul-de-sac and there's no exit out of the cul-de-sac. But what I can tell you is that to maintain any sort of momentum, it's not a linear relationship. It's actually a logarithmic relationship. In other words, they have to do more and more and more and more in ever quick succession just to stand still, right? And that's the thing that I don't think that central bankers have got their head around, right? Because as you say, what is the limit? Is there a limit? Or do you just go on doing it ad infinitum forever, right? And get interest rates lower and lower and lower till they tend to zero or below. But then I come back to, well, hang on a moment, what are central banks for? What is the economy for? Isn't it about the real economy and the real fabric of society, not just maintaining this artifice that we've got, which basically is maintaining the air of financial stability and reasonableness within the financial markets while the real economy goes to hell?
That's absolutely. And one of the things that really gets me about all of this is that, if you look at something like the World Economic Forum, you look at things, like the G20, and they talk about globalization. They talk about the positives of globalization, about how all of this is benefiting people, has lifted X number of people out of poverty, blah, 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 blah. But the other side of globalization is the fact that everything is interconnected, and you can't just screw around with the system, pumping trillions and trillions of dollars into it and not expect to start screwing things up and breaking things. Because even though in the rest of here in Australia, in Europe, in America, in Canada, we do all this financial engineering crap and cap our bond yields, and we do QE, and we do all this other crap that shouldn't frankly be possible and nor should be done. But if you're in a country like Russia, or if you're in a country like Brazil, or if you're in any number of emerging market nations that is now having to raise interest rates. Mexico raised interest rates out of the blue just I think it was this morning. Yep. And this is going to crush people. This is going to absolutely crush people in the developing world. And while, we might not feel it in the rest of the world for quite some time to come, you're going to have people in places like Mexico, places like Brazil, places all across the world getting crushed by rising interest rates, appreciating currencies if the Fed does go off the deep end, rising costs of commodity prices, and more than that, they're still dealing with the bloody virus, and they're going to be the last people to deal with it in terms of getting rid of the thing. Because they don't have the resources that we do. Because especially here in Australia, we can just shut the borders and say bugger off. We can just cut ourselves off from the world. But if you're the Philippines, or if you're Brazil, or if you're Tanzania, you can't do that. You're going to get freaking crushed by this idiocy that the Fed and the rest of these central banks is undertaking, with absolutely no regard for what they're doing to the rest of the world.
No, I agree with that, and then I'll just overlay finally the climate change issue and the disruption which is going to be created there. Put that into the mix as well, and you can see that we actually are in quite a precarious state. And you're right insofar that places like Australia and the US probably will be able to muddle their way through in some way, but the bulk of the world population doesn't live in Australia or the US.
No, they don't, and it's just such an absolutely disastrous set of circumstances. I mean, I'm not sure if you saw on the ABC the other day, but the Chinese have been allegedly manipulating their data on the level of their agricultural harvests, and they've been allegedly lying about that, and they've been doing that to deliberately suppress commodity and food prices, because, well, food prices are the key ingredient. Not necessarily a singularly key ingredient, but a key ingredient in revolutions. Yep. I mean, the Syrian government found that out the hard way, and lots of other people have found that out the hard way throughout history. The French aristocracy certainly did. But it's, and not only that, but global food prices are rising. People say, oh, it's about inflation. It's like, yes, that is part of the equation. But the other part of the equation is because we've had droughts, because we've had all of these various factors, everything from locusts to viruses infecting poultry and pigs, all of these things coming together to create price pressures and shortages and all these other different issues, which are going to hit emerging markets far more than us, because we can afford to pay extra at the supermarket. We still get our bacon, we still get our vegetables, but in the end, that means that other people in developing nations may have to go without.
Yeah, I agree, Tarric. It's certainly very concerning, and I actually have this theory that ultimately the next set of wars will be more likely to be on water than anything else, because I actually think that with global warming and everything else, water becomes then probably one of the most precious commodities there. And I'm thinking back to Frank Herbert's Dune. I don't remember you watched that sci-fi series rather at all, but
oh, big fan.
Yeah, but the point there is, it's all about water, right? It actually, that is the essence of life, and I suspect that perhaps sometimes it will be good just to sort of stop and think about, where is the real reality? Where are those basics? And, where is this journey that we're on taking us? Because I'm not sure that I like the destination. If June is the destination, can I get off now?
Yeah. Well, I wouldn't mind living on Caladan, but I'm not really too keen on Arrakis. I'm not going to lie.
And watch for the worms. Tarric, I really appreciate your time today. Very insightful as always. And I'm sure we'll do it again soon.
Yeah, definitely, mate. Looking forward to it.
Cheers. Take care.
You too, mate. Bye.